What is going on, everyone? Welcome to TradeZella's webinar. So in this webinar, we are going to talk about managing risk like a pro, right? So one of the biggest problems traders have, in my opinion, is managing risk, right? So there's so many times, I'm pretty sure people on here can relate, where you'll take a position and one position or two trades a day or a week or whatever the case is may ultimately destroy your whole trading performance in a very short period of time. So in this webinar, we are going to cover the following. What is R multiple and how to use it, which I think is a very effective thing everyone in here should be focused on. How to improve your R multiple, identifying your weaknesses in your risk, bankroll management, and risk management strategies. So we're going to kind of try to cover this in the next 40 minutes. Might go a little bit over, but these are the main components we're going to focus on, right? Now, first thing I want to bring up before we get started, for all traders, the main thing everyone here has to understand is our job as traders is to manage risk. That is our main job each and every single day. How you manage risk will ultimately identify how you perform as a trader and how long you allow yourself to last in the trading space, right? So every single day, the main thing we want to focus on is the risk component. So I want to the first thing I want to do is, before we dive into anything, I want you guys to flip your mindset, right? The mindset that we're going to flip while we dive into this topic is we are going to go into the risk protective mindset. We are not going to go in the reward mindset. That's number one, right? Majority of traders, right? And I'm pretty sure people on here relate. Majority of traders are in the reward mindset. What I mean by that is, the moment you get into a trade, let's say you buy a stock for $1,000 or $2,000 or whatever the case is, the moment you enter a trade, the first thing you do is, oh man, if I'm right on this trade, I will make X, Y, and Z amount. If I'm right on this trade, I can make this much. So you start focusing on the reward of the outcome without even getting to the end point. What we want to flip is, now when you get into a trade, before and even during, we want to gear towards the risk aspect. Hey, how much am I risking, right? If this is the amount I'm risking, what will I actually need for the trade to do for me to be wrong? And how much will I lose if I am wrong? This is, once again, the mindset that I want everyone on here moving forward to be really, really focused on every single trade that we take moving forward, right? With that being said, let's talk about the first point, R multiple. What is R multiple? So in my opinion, R multiple is one of the most important ways to measure the success of a trader. So a lot of traders, the main thing they focus on is they focus on the outcome of a trade by saying, hey, I made $500 or I lost $500. That's the main thing they focus on. What I ultimately care about, and I think everyone on here should focus on caring about, is what did you risk to make that, right? What was the risk amount? So for example, if I risk, right, let's say $5,000 to make $2,500, right? Is that a good trade? Absolutely not, because I risked $5,000 to make $2,500. That is not a good trade. So next time you see any trader, or even yourself, make a certain amount on a trade, let's say you have a $2,500 day, don't immediately go and say, I made $2,500, great. No, ask yourself, what did I risk to make that? And sometimes you will actually be very, very surprised, and you will see that you actually didn't, you risked a lot to actually, obtain those, the final number. So when I go through my R multiple, when I look at my realized R multiple in TradeZella, there's days where I have a great R multiple. I'll have a 2.5 R or 2.35 R, but there's days I have a 0.61 R, right? It's like, okay, well, this doesn't really make sense, right? Based on how much I made and based off how much I risked, the trade isn't an ideal trade in my opinion, right? An ideal trade is where I'm risking, like, say if we go to this trade right here, I had 0.21 R, right? I made about $171, but I risked almost $800 on the trade. So not a good trade. So to tell you the calculation of the R multiple, you guys don't have to do it. If you have TradeZella, it'll do it for you. I'll show you how. But basically, R multiple takes your risk based on your stop loss and divides it by your final outcome. So in this situation, let's say we call it situation A. Let's say you make $200 on a trade. Now the question is, based off your stop, how much did you risk? Let's say based off my stop, I risked $100, right? But I made $200 on the trade. That gives me a 2R, right? So 200 divided by 100 is going to give me 2. So that's a 2R trade. Now, if you take the same trade and let's say we made 600 on the trade and we risked 100, now 600 divided by 100 is 6R. So it allows us to look at it from an R perspective. Obviously, the higher the R multiple, that means the more you made based on the amount you risked, right? So that's very important to understand. Now, on the downside, it's pretty opposite. So if I risk, let's just say trade outcome is I lose $100, right? If I lose 100, I risked 100, I now have a negative 1R, okay? So let me just duplicate that. So now I have a negative 1R. But now if I have, let's say, lost 600 and I risked 100, now I have a negative 6R. Right now, the difference between negative 1R and 6R, another thing to keep in mind, is negative 1R means I basically followed my stop. It doesn't mean my stop was good. It doesn't mean that my area of risk was good. It just means I followed my stop. Now, if I have a negative 6R, that right away means I did not follow my stop. Okay, and as I keep progressing, guys, things are going to start clicking. So if it's your first time being exposed to this content or the R multiple or anything related to risk, as I keep progressing and I show you examples, things will start clicking. And by the way, this will all be recorded and it will be uploaded so you guys can come back to it whenever you want, right? So those are two components to remember about R multiple. There's a negative R, there's a positive R. Anything more than a negative 1R, things start looking bad where it's like, hey, you didn't follow your stop, and anything less than that identifies, hey, you followed your stop. And then the next step is obviously identifying, was your stop a good stop, right? That's something we'll dive into a little bit. So here's two examples of a good R multiple and a bad R multiple, right? So if we take a look on the left side, right, you can see here a lot of money has been made, right? And majority of the money, the trades were above 2R, right? There was trades that were about 300,000, about trades of 200,000, and so on, right? And then when we go down here, we'll see we had a lot of trades within the range of, you know, negative 1R. We had a few trades in the 1R to negative 2R, and we had a couple of trades outside of that. Now, what does this all mean, right? So for the trades that were outside of 1R, that means we did not follow our stop. That's a big, big, big red flag, right? So when we look at this data, this is a bad R multiple, because look at how many times, right? Almost in this situation, how many times we lost about more money than we initially should have because we didn't follow our stop, right? About 30, 40 grand gone just right there. And then when we look at the profitable trades, we don't have a lot of trades above 2R, right? So the rule of thumb is we want to try to aim for a 2R plus. Anything above that is great. 2.5 is ideal, but 2.5, 2R is what we want to aim for. We want to try to make twice as much as we risked on each and every single individual trade. When we're wrong, we want to be in the negative 1R, no more than negative 1R. And then eventually we want to work on identifying, was the negative 1R a good place for stop, a good place for our stop, right? And I'll dive into that in a bit. So once again, good R multiple versus bad R multiple, we'll start seeing a lot of trades, a lot of losing trades above the 1R. And once we start seeing that, that becomes a big red flag. And then it's like clear signal, hey, you're not following your stop. And that's something that needs to be really, really focused on, right? So now I want to show you guys an example, right? So I want to show you guys basically math on how all of this works out, why it's important, so you guys can see like the real raw data, right? And then I'll run you through some of my data. I'll run you through some of the trades I've taken, why I've taken the trades, you know, what the outcome was and things like that, just to give you some idea, right? So this is how some people's R multiple looks, right? So when we look at this, we'll start seeing ranges. So we have negative 1R, we have negative 2R. We can also go to negative 3R, negative 4, and so on. But I'm just going to keep it in this range, right? So what this is identifying so far, right, is right now, this is identifying, right, there's a few times we didn't follow our stop. And let's just use this as a trade count, right? This is how many trades were taken. In this situation, about, let's say 10. In this situation, about 15. About a 1R almost, we had 40. A lot of trades at this 70 number, some trades at the 40, and there was a few trades above 3R. Now, most of the time, what I've seen in my trading career is most of the time, this is where majority of your money is made. If you can maximize this component, that is one area where if you learn how to maximize this, you will allow yourself to really, really do extremely well. Another area that becomes very important for traders is to learn how to work on this. How do we lower this number, right? How do we take that number and how do we lower it to this 1R area? Like, how do I make sure that this 1R area is where we're filled? And how do we get rid of the 2R, where we stop having bad trades, where we stop having bad trade outcomes? That's another important thing that we want to do. Then the third thing, right, and I'll put it all together for you guys in the end, is making sure when you are wrong on a trade, was that a good wrong? There's a difference between a good wrong and a bad wrong, and I'll talk about that. Those are small metrics we want to work on. So I'll show you guys an example, and then we're going to put all of this together, and then I'm going to recap before going to the next stuff, because I know, once again, it feels too much for someone that's new to this, right? So let's take a look at this, okay? Now, we're going to paint the picture here, and just stay with me real quick, right? So let's just say your average risk on a trade, we're going to keep it consistent, right? And keep this in mind, guys. If you are a beginner trader, if you are someone that has not been able to achieve consistency or profitability, make sure you keep your size consistent. Make sure you keep your risk amount consistent. Do not increase your risk, decrease your risk based on different situations, especially if you are not profitable yet. Keep that in mind. Once you get profitable, it's okay, because you get better at managing risk. You get better at identifying great opportunities and bad opportunities or mediocre opportunities. At that point, it is okay. But starting out, do not increase or decrease your risk massively. Keep it within a certain range, okay? So in this situation, let's just say we take an example, okay? We say this person is risking $300 per trade. Every single trade this individual takes, they're not risking more than 300. Now, this number can be altered. We can make it 600, we can make it 6,000, we can make it 60,000. Doesn't matter, but we want to keep this number consistent, right? If it's 300, if it's 280, 270, or 320, 330, it's still fine. But we don't want to go from 300 one trade, and then the next trade we go to 2,000, or the next trade we go to 1,500. Way too much of an increase or decrease in risk, right? Now, we're going to break this down really quick. A negative 2R means if you risk 300, right? That means your outcome, if you hit a negative 2R trade, is negative $600. So basically, if I see negative 2R on a trade, now basically whatever my risk amount was, it's multiplied by 2. So in this situation, if my risk, let's just say hypothetically, was 100, right? Right away, this is 200 because it's multiplied by 2, right? Everyone on the same page for that? Everyone's good? All right. So now let's keep that in mind. Now, if my R is, let's just say negative 1, that means if I risk 300 and I'm wrong and I get a negative 1R, I lost 300 on the trade, right? See, it stays consistent. Now, obviously, if I go deeper, if I go 1.5, right, and I really, really want to, the numbers start adjusting. Now it's 450. If I go 1.2, which happens, right, number's 360. So those numbers are adjustable even if it's like 0.1, 0.5, but we're just going to keep simple math and just focus on this. Once again, if your R is negative 2 and you're risking 300 per trade, that means your outcome will be negative $600. This is what we want to avoid. Why? Because if you follow your stop, your loss should not be more than 300. See, that's the one big important thing. This is why, number one, why it's important. Now, if you risk $300 and you have a positive 1R, right, you will make 300 bucks. If you have a 2R trade and you risk $300, that means you're making 600 bucks. 3R trade, risking 300, making 900, right? Everyone got the math? Everyone understands? All right. Now, this is where things start getting tricky, right? So we're going to start plugging in numbers here, okay? So this is how most people's trading looks, right? And I'm going to the people that have consistent risk management. Right now, people that don't have consistent risk management, it's even worse. So let's just say someone has a consistency in how much they're risking over and over again. So in how many trades they've taken, let's just say this person has, let's start adjusting 20 trades here, right? They go 20 trades here. They have, let's just say 35 trades here, right? 0.4, or let's just make it 0.5, right? Let's just say they have about 17 trades here. Let's just say here they have 22 trades. Let's just say in 2R, they have 5 trades. Let's just say in 3R, they have 2 trades. Right away, you start seeing how someone's P&L starts getting adjusted, right? What starts happening with the outcome, right? So when we start seeing it, even if we keep the trade counts consistent, let's just say I keep this at 10 and I keep this at 10, right? We can see how much of a difference, right? Just me improving on some of the trades makes, especially if I start aiming for a 2R. We start seeing the numbers legit go up by 100%, especially on a larger scale, right? So it starts making a big difference in that outcome performance. Now, in most people's situations, these numbers are not consistent. What happens is on some trades, they might go and say, you know what? Whenever they go to a big size position, and this is where position sizing kicks in, their risk may go 700. They might have, let's just say, 9 trades in this department, right? Here, they may be risking 500, but they have a lot of winners. Let's just say 19 winners, right? Let's just say as they keep going, here, they're risking, you know, as this scale up to certain trades, the risk starts decreasing, right? Now, their numbers start adjusting. Now, the problem when this happens, when this number starts getting altered, your trading is not, it's not contingent on the R anymore. Your trading is contingent on what risk you set and what risk did the best for you. So hypothetically, let's just say magically, when you had the negative 2R, you were risking $50. But when you were risking, when you had 3R trades, you were risking 1,000. Immediately, if you look at your trade outcome changes. But now let's just say when you were risking a lot of money, you weren't able to manage it, right? You risk 5,000. Let's not even go to 5. Let's just keep it like 1,000. Okay. You're risking 1,000, right? Once you're risking 1,000, you start risking 1,000 some trades, you do terribly wrong on them. And then when you start increasing size, you're also not risking 1,000. You may be back at the 350 mark. What starts happening is your P&L starts suffering and starts taking big hits over and over again. So the 2 things that I want you guys to take away from this, right, is when you guys are taking trades, number 1, keep this consistent. That's number 1. That's the first thing we want to do. We want to keep this consistent. Just going to put C. Keep your risk starting out as consistent as possible. Number 2, I want you to have a level of all your trades, and I want you to have an R on every single trade, right? Once you have a R on every single trade and you have a level identified in every single trade, now the goal becomes in trying to identify it. So if I go on here, right, let's just say I go on my R multiple, I start seeing all my trades, right? So if I go on to, let's just say my trade from 2R to 2.9R, and I want to understand them, these are all my trades from 2R to 2.9R. Now I can start understanding them, right? I start getting a clear idea. If I go on these trades, I'll start understanding where I got in, where I got out, how much I risked, whatever the component was, just to get a good idea of the trade, maybe a good idea of the trade outcome. What were the mistakes I made? What were the setups? So I start getting a good idea on each one of these components in each one of these trades, right? So now if this is consistent, that right away allows my job to be very, very easy, right? Now, if this is inconsistent, now there's no area for me to identify what in my risk I have to work on, right? Because the thing a lot of traders try to do wrong, in my opinion, is when they start out, let's just say this is your P&L, they're trying to go right here in terms of financial. I want to make a lot of money. Great. We all do, right? But in order to do that, we have to identify where your weaknesses are, what areas you need to work on. And in order to identify that, you need to keep certain things constant, in my opinion. Number 1 thing to keep constant, once again, and I keep hammering on this because I think it's very, very important, is risk. Let's go on risk. Let's make sure our risk in every trade is consistent. So everyone on here moving forward, going into tomorrow, going into day after tomorrow, whatever, identify what is your max loss per trade. How much should you risk on a trade? How much should you keep as your max loss? No matter what happens, you are wrong. And then from there, your job is to identify position sizing. So let's identify position sizing really quick, right? Just a quick rundown for people that are not familiar. If your risk on a trade is $300, right? The way to identify what your risk will be on a trade is, let's just say I want to buy a stock at $10. My first thing before I personally take on a trade for options, stocks, futures, whatever the case is where does this need to go for me to be wrong? Not where does this need to go for me to lose $300? No, where does this stock need to go for me to be wrong, for this trade to be invalidated, right? Let's just say as it's at 10, let's just say for math purposes, if it goes to 9 or below, there's a high probability it will go lower. So I go, okay, well, if I buy a share at 10 and I put my stop at 9, I lose $1 per share if I am wrong. And remember, don't ever go into a trade looking at the reward. Go into a trade looking at it from a winning perspective. From a losing perspective. Do not look at it from a winning perspective. If I am wrong, I lose $1 on this trade. Now, the simple math to calculate that is $1 divided by $300 will give us 300 shares. So I can only buy 300 shares. Why? Because if I buy 300 shares at $10 and it goes down to 9, I will lose 300. Not saying I want to lose 300, but I want to have that risk identified. Now, if I lose 300, I was well prepared for that loss. I understood what I was going to lose, and that went alongside of my risk management strategy or risk management plan. Now, and this happens too, and I'm pretty sure people on here are aware, I might buy a stock at 10, it goes to 9, I wait, I don't sell, it goes to 8, and I lose $600. Now, if I lose $600, now I have a negative 2R, identifying that I did not follow my risk. I did not follow my stop. I did not follow what was planned originally. And that is a big red flag. Okay. This is something that we as traders want to make sure we are trying to stay at the 1. Anything above 1, and I've had days, guys, where I've had my R multiple above 1, negative 1. And I've had days I didn't follow my stop, especially for option traders. It gets very, very hard in some trades. And that's where we need to become better at assessing risk. And some days it's not even about assessing risk. We just, like for me personally, I don't sell. I'm like, oh, it's already at 9. Let me wait a little bit more. It goes to 850. You're like, let me wait a little bit more. And then next thing you know, you're down, 20%, 30%. And this ultimately just impacts your trading so much, right? So we want to make sure that nothing is going above 1R. Okay. Now, when you guys see this, that's ultimately how to calculate it in terms of position sizing, how to calculate it in terms of size, and just to get a good understanding of each and every single trade that you guys have, right? So that's once again very important. I think once every person here should switch their mindset. And guys, like I mean this, I don't mean to be negative about it. Until you learn how to manage risk properly, I don't care how many times you're right, how many great trades you've had, in a long period of time as a trader, you will not be profitable. You will come across a roadblock, no matter how good you are or you think you are, you will come across a point where if you do not know how to manage risk and manage yourself as a trader, you will blow up. And I've seen it happen so many times. So make sure you religiously follow this and you religiously make sure every single trade you have risk parameters on, okay? So that's the way to identify your risk. Now, when you do, like I said, you want to identify the small little tweaks and fix them, which I'll show you guys in a bit. Right? All right. We are going right here. Now, a big question that everyone has is, how do you calculate your risk with options? Right. So we have a video on it. If you guys go in Zella University, there's a video on it that breaks it down, but I'll do like a quick breakdown. So you can do it ultimately with delta, right? Stop loss for options. So we've been working on something. We're testing it out. I'm aiming to have it out by end of December, where you could put a stop loss on the stock price, and it will, on TradeZella, it should give you, where the stock was supposed to be based on the Greeks, right? So right now, ultimately, the way it's working is, the way we're doing it right now is, if you enter an option at 265, my stop was at 250, so risked about 2,900. That's how it's calculated, right? But to do it on options for that, people that are option traders, just like a quick thing is, I do it off delta. You can get a good idea off delta, right? So just to give you an example, quick rundown, delta, basically if delta is 50 cents, that means on every $1 move, right? The option premium will move 50 cents. So if an option premium is 250 and the delta is 50 cents, if the underlying stock let's just say moves up or down $1, this will move down 50 cents. So ultimately what I do based on the options I do trade, I have a strong understanding of, what I'm trading, how they're moving and things like that. So if I'm buying a certain option at a point, let's just say at 377 and my stop is 376, let's just say it's $1 below my entry point and I understand delta is 50 cents and I'm entering around 250, I'll say, well, my stop is $2. If my stop is $2, this is what I'm expected to lose. And remember, guys, delta will fluctuate, especially when you're trading same-day expiration. Like same-day expiration, like if an option is, let's just say 250, I've seen delta be even more, right? I think it was with SPY. I think SPY was 97 cents, same-day expiration. I think delta was 60 cents. So on every $1 move, you're losing about 50, 60% of your option contract price. Right. And that's why people blow up their accounts because they don't assess for this. They'll say, well, I'm buying a stock. I'm buying options for 97 cents. I'm going to put a stop at 80 cents. But with the stock price, 80 cents is expected to move down. They're expected that it's going to move down $1. But that's like you don't have basic understanding of options there, in my opinion. And if that's something you're having a hard time with, once again, take my advice here too. Go and trade shares. Build your knowledge with options, understand how they move, understand what causes the fluctuation, understand how Greeks play a role, understand how theta plays a role, understand these things before you go and blow your money with options. Because if not, very high possibility you may blow up your account. I hope not, but that's ultimately what happens with people because they don't understand risk. They don't understand these basic areas for trading the underlying security they're trading, right? So just want to break that down real quick. Now, going back to this, right? Now, once you guys are trading, or and let's just go off two assumptions, right? And I'm going to go into how to identify your risk, right? Now, let's just paint two scenarios, right? Let's just say we have two traders really quick. I'm going to erase that. So everyone on here is either A or B or even C, right? And I'll break down each trader. You can identify which one you are. A, you've never had any success in trading. You're kind of all over the place, right? B, you'll have a good week or two and then you blow it all away. And then C, right? You're just like losing money, right? You have no consistency. You're just on a downward trend, right? So which one ever you are, and then obviously D, traders that are already consistent, that are already maybe making money, have bad days, obviously like everyone else, but they're staying alive, they're progressing day in and out. If you're that, great. If you're A, B, or C, we need to kind of work on it. Okay, now how do we work on it? What do we do? Let's go back to the drawing board and let's start from scratch, right? And this is the main thing you need to understand, guys. Forget about what's the holy grail strategy. Forget about indicators. Forget about all that. That's secondary. Right? Because if you can't, once again, and I focus on this a lot, if you can't manage risk, if you can't manage yourself, if you can't manage expectations, you will ultimately blow up as a trader sooner or later. So if you're ABC, let's go and identify what you need to do, right? So first question for everyone on here, and I want you to answer honestly, right? The first question that I have is, do you guys have a financial number that you risk on each trade? Like, hey, on every trade, I will risk no more than $300. I'm not saying how much you're going to invest. I'm talking about risk. That's the first question. Do you guys have that? I want you to think about that. You might say you have it. You might say, I've never came up with a number. I just go into trades blindly and I buy stuff left and right, either or. Now, if you do have a number, great. Now let's go up to my follow-up question for people that are like, I do have a number. It's 300 or it's 3,000 or it's 5,000, whatever the number is. Now, do you consistently follow it? That's my second question. Do you follow that number? Do you go to every trade and do you keep your position size, your risk size consistent on that over and over again? If you do, great. Now we have something to work with. Now we know what to work on, right? If you don't, this is the first thing that needs to be done to be able to work on anything, right? So we want to work on this, but for us to work on it, we need proper data. So that's another thing that most traders kind of don't get. And someone said, isn't risk the amount you put in a trade? No, absolutely not. Risk is what the proper way, in my definition. My definition of risk on any single trade is what amount you will lose if the trade is invalidated. If I put $5,000 into a trade, let's just say I have stocks or options, right? Because both are going to play differently. If I have stocks, right, and let's say the share is at $10, ultimately, if I put $5,000, it needs to go to zero for me to lose my $5,000 for it to be a risk, right? Now, obviously, I'm not going to put $5,000 into a trade and say, well, I'm going to let it go to zero, unless that's my strategy. And there's very few people that have that strategy. It works for some people, but very few, and they're really thought out, right? So I don't want to say it's not a real thing. Very few people do that. Now, the other thing is if I'm trading options, if I buy an option contract for $295, now this is where it gets tricky. Most people do let it go to zero. But the question is your game plan saying to let it go to zero? Where does your game plan invalidate this trade? Does it invalidate it when the stock goes down a point? Does it invalidate it when the stock goes down 2 points? When does it invalidate? So let's just say it invalidates it at $2. That is what you are risking. I look at risk in a point where if this is a stock, let's just say stock is a 10, I think the stock has potential to go to 13. I have potential to make $3 in the trade, but I understand that I have to have some skin in the game. I understand I have to put some risk out, and I understand I could be wrong. Now, what amount, dollar amount or share amount or option contract amount am I willing to risk to identify if I'm right or wrong? Now, obviously, if it's $1, right, now it makes sense because I'm looking at a potential 3R trade. I'm potentially looking to make 3R. Like I'm looking to make $3 to possibly lose $1, right? And sometimes it'll be less. Sometimes, things happen that'll adjust. It's not a perfect world in trading. I'll tell you that right now, but that's our job to understand that. And if we're wrong, yes, I put $10 into the trade, but essentially I risked $1. And that's the risk. That's the way we want to look at risk. That's the way we want to identify risk. And that's the way we want to understand it, right? So we want to keep that consistent, and we want to have the right data, in my opinion, to keep it consistent, right? Now, what do I mean by that? So it all starts with proper data collection to identify your weakness. To identify your weakness in anything, you need to have proper data collection. It applies to everything. It applies to trading. It applies to working out. It applies to a business. Whatever it is, you need to have proper data collection, right? So to give you an example, let's just say we have a store, just to go off trading. Let's say we have a store. It is a pizzeria, right? Let's just say in the pizzeria, we get sales for the day, or we make $1,000, right? Let's just say as we're making $1,000, we're not tracking all of the trades. We're not tracking all the transactions. Hey, $50 went to drinks, $100 went to steak, $200 went to sandwiches, $300, let's say, went to pizza. And I want to identify how is our pizza business doing? How well are we doing when we're selling pizzas? And what type? We won't be able to understand if we don't have the proper data and we're not tracking that data, right? If we're all over the place with no proper system, no proper way to measure it, no proper way to track it, we will not be able to find where our weaknesses are in our trading system or in our business or whatever the case is. So the first thing that we need to all do collectively is have proper data collection. And I'll show you guys examples. Second is we need to keep our risk consistent. Like I said, if you're trader A, B, or C, you need to have proper, consistent risk on each and every single trade, which goes hand in hand with proper data collection. They both work together. So now if you are moving forward and you're like, hey, I want to take this trading thing serious. I don't want to just wake up and put on trades and blow my account and keep funding it every week or every month or whatever the case is, and be stuck on this 2-year cycle that I see so many people stuck on it. And I want to actually give it a fair shot. Let's do the following. Let's make an actual trading plan, and let's start identifying the first thing, which is risk. How much will you risk per trade? Now, that is contingent on everyone's account size. If you have a $100,000 account size, right, I don't expect you to go and say, I want to risk $15 per trade, right? Your risk may be a lot more. Some people may have more risk tolerance. They may have a 20K account, and they may say, I want to risk 2K. Some people may have a $1,000 account, and they may say, I want to risk $50 per trade, right? Now, if you have a $1,000 account, don't go and say, I want to risk $500 per trade. 2 trades and you're gone. In the early stages, we want to allow ourselves to have the most opportunities in the market. Like, I want to be able to take the most amount of trades, real trades, and mess up as much as humanly possible, but not have a big drawdown in my account. I don't want to lose a lot of money. But also, in retrospect, if I do that And when I'm right, I also won't make a lot of money. I need to be okay with that, because my goal here and your goal here right now should be, how do I stay alive for the next 4 or 5 months with my current account size, where I risk the least amount, so I have proper data collection, I understand trading better, I understand what I need to work on, I understand, are my stops good? I need to understand, are my setups good? What setups work? What setups don't work? These are things that I, as a trader, need to understand, right? That's where the next couple of months, if you want to take it serious, doing the following is the first step, in my opinion. Now, once you do that, your job is to put on trades. Right now, when you guys put on trades, I spoke about this in the last video we did. Every single trade you guys take on, every single trade needs to have a setup. What was a setup? Identify your setups. Now, if you go, hey, Umar, I have no setups, I've been trading for 2 years, then you're gambling. Like, what are you looking for? Oh, I'm looking for high of the day, low of the day. It's not consistently going to work in the market. Okay, well, now when I see, the funny thing is, when I ask people, explain high of the day, low of the day, it's so frustrating, because it's not a real thing. It's not even a real setup. People might say, well, if it breaks this level, that's the high of the day, I'm going to buy. Okay, now I'm going to go deeper. I'm going to go very deep into this. Okay, what are the factors that will identify? What are the factors to you? Forget everyone else. What are the factors to you that will identify that this security, stock, future, whatever the case is, has strength to go up? Well, volume. Okay, well, how do you know it's strong volume? How do you know what the market conditions are? How do you know what other aspects, external and internal factors, do you look at to confirm this high of the day or low of the day? And most people don't have that. And then they'll have one trade, they'll make money, they're risking $300. They're like, oh man, if I risked 3,000, I would have made so much more. Second trade, they take it again, increase their risk, lose money, blow their account. That's not what we want to do here. We want to have real setups. We want to have real understandings of setups. What setups make sense? What setups don't make sense? And you don't need to have 20 different setups. You need to have 2 or 3 setups. Wait, see when the market shows you that setup. Maybe it doesn't show you that setup for 2 weeks, right? Now, if let's just say you have 2 setups, right? And the market doesn't show you those 2 setups for 2 weeks. Okay. Now, my question is, can you sit on your hands and not trade when the market doesn't present you an opportunity based on your trading style? If your answer is no, I will go back to the same thing. You are going to blow your account. You are going to not be profitable, if I'm being honest. So these are some things that in that time period, in that learning phase, in that growth phase, where you are taking the most amount of trades, where you are allowing yourself to have the most amount of opportunities, you are also looking at it from a point where you want to stay alive. You're not increasing risk. You're not increasing size. You're not taking massive trades, and you are able to recognize your patterns, your behaviors, your understandings as a trader to know what you need to work on, what you don't need to work on. And as something as small as, hey, I know people that cannot sit on their hands. They'll wake up, they'll get in front of the computer, market opens 10 minutes in, they took a trade. You ask them to break down their thesis. I have no idea. Now, when they're right, you ask them to break down the thesis, they'll give you a perfect thesis because they were right. But it needs to be consistent. Once again, keyword here is consistency. We want to keep consistency in all aspects, right? So once again, proper data collection, consistency per trade, identify each trade with the following. Number 1, setup. What was the setup? So here, I'll give you guys an example because we have this trade open. Have a blowing top, sold early. I also kind of entered a little bit late, in my opinion. Just picked out a random trade here. We opened up. We're already in downward movement prior. Opened up, heavy rejection at 370, 750. Saw the weakness there. Wanted to let the trade kind of marinate a little bit. Entered a few minutes in. Right when I entered, the first break, low of the day break, I exited. Few mistakes I made. First, before we go into mistakes, just to give you a rundown, I had a setup blowing top. Stock opens up, doesn't have real legs behind it on the open, starts showing weakness at a key level, even if it's a minute or 2 in. Once we start getting stagnant, I start identifying it there. If we see weakness here, I'll short or I'll buy puts and I'll play a little move on the downside. So my setup was good. Knew where I was going to sell if I was wrong. Mistakes, right? I sold early. I hesitated. I sold early. I didn't really have a reason to sell early, if I'm being honest. I could have scaled out a lot better, maybe made another 7 or 8 grand. But avoiding the 7 grand or whatever the number, had a 2.5 hour trade. I'll take it. I'll live with it. I'll move on. Right. But these are things that we as traders, we want to track. We want to understand. Right. And even when we look at numbers, like, this is irrelevant. This means nothing. In my opinion, this means nothing. Right. So here, I'll show you an example. Right. Let's just say I go here. Instead of 250, let's just say this was 20 cents. Okay. Now let's look at this trade, right? Now people like, see, everyone's so focused on the 7K. Wow, you made 7K, great. But now what if I'm like, hey, well, I risked 47,000 to make the 7K. Is that a good trade? No. That's why even when you see anyone, including myself, even if you see me post something on social media or any trader on YouTube, Instagram, Twitter, whatever the case may be, look, understand it from a risk perspective. Well, how much the risk? Okay, great. I put 51,000. This is what people look at. Oh, well, you had to put 51,000 to make. Yeah, but what was my risk amount? And then am I consistent with it? Because I like, this is another thing with option for option traders and some future traders. Another thing could be I could let this expire to zero. The trade may be reversed and it goes to, let's just say, almost zero. I risked $51,000. Now, if I have that, now that's a big, big, big problem, right? So these are things you as a trader want to understand. You want to identify, you know, how are you kind of playing the trade out? What's the setup? What are your setups? So you have proper data collection, because now when you have setups, now what you want to understand is you can identify your R multiple based off setups, right? Because some setups you might see like, wow, when I play this setup, I start having a lot of 3R trades or 4R trades or even 2R trades. But when I play this setup, I barely make it to a 1R or 0.5R. And it's not consistent, because if these trades go against me, they will really, really hurt my trading account. So now this is where we start going deeper, where we start going, well, how would it be if I had certain trades? How would it be if I had certain setups, right? So let's just say I go to, I don't know, morning top, right, setup, or morning rejection, right? Let's just say I want to see my morning top and rejection. Now I start looking at this and I'm like, okay, well, this setup has actually done very well for me. I had 2 days where it didn't do well. Obviously, my size was a little bit inconsistent, but I had a lot of 4R trades. I had 2 4R trades, 3 to 4R, 3 above 2. So I did fairly very well. And if you look at this, guys, this is what I was saying. If you just look at, right? So on 1R, I made about 10K. Upwards 2K, I made 16K. 2 to 3K, I made about 6K. And then above 3Rs, look, where I start making the most amount of money. And for most traders, it's the same exact thing. And the reason for that was because my size was, you know, inflated or adjusted for this, but my size wasn't reduced on this setup. It was an appropriate size that I was able to maximize few trades going into this. And if you look at the setup, 2, 3, 4 trades where I've allowed myself to maximize the trade fully, do its job, right? That's another thing, very important to identify that, right? Because you guys want to like see now this is where you start getting deeper, right? Where it starts getting deeper, where when you're now looking at your R multiple, right, there's different components to look at, right? How is my R multiple when I trade a setup? How is my R multiple when I make the following trade? How is my multiple on the second trade of the day? How is my R multiple when I see a drastic increase or decrease in size? So now you start playing around with different R multiple views. And this view goes for everything, setups, mistakes, things like that, where you're like, wow, this is actually a really big problem. This is where I need to really identify my weakness. This is where I really need to identify my strength, right? And that's where, right, we go on to the third thing. Right? Look at the trade after the outcome. Right? I always tell traders this, like, you know, you want to improve, go back to your trade again. So one cool thing we have on here is we have a replay feature. You can go back, you can replay some of your trades. I'll show you guys something really quick. So if I go here, right, another example, entry, short, exit. Now, obviously, in a perfect world, right? And like I said before, perfection does not exist in trading. Perfect world, I wish I held these 2 trades into here, right? If I look at, you know, some of my exits, right? 216, I look here, 201, I look here about $1.65. So that would have been a big drastic increase in terms of price, in terms of, you know, total profit. But once again, not a perfect world. Things don't work out like that. Now, what I want to see on my trades is after I exited, after I'm done with the trade, what happened, right? Did I exit at an appropriate time? Why did I enter here? What did I see? So we have a replay feature here. You guys can check it out. When you hit replay, you can kind of play for that day, play second by second, minute by minute, just to get an understanding of how that day went, right? Just to see the price action. We're at 10x speed right now, and just see where your executions were, right? Where did you buy? Where did you sell? Why did you buy? Why did you sell? Hey, I entered the 130 puts in Amazon at this time, right? This is where I entered. right? I start seeing some tightness. We go above the 10 a.m. area. Morning top reversal. I'm assuming we're not breaking this 130.40 area. So I start entering, and then I enter more on the second area. And then right when we start dumping is where I start scaling out. So as we go to more and more time, and I even let this play, let's just say I let this play, we can start getting a clean idea of how everything is moving. We start getting a clean idea of what is actually going on, right? How is this trade moving? How did it move after? Oh, I sold here. I know why I sold here. Now, when I see it from this perspective, I start seeing, well, we started seeing a hold here, and I'm like, okay, I don't want to get caught up in a reversal. So I'm okay with that from a psychological level, psychological barrier. I'm okay with that. I'm okay on exiting there, right? So when you go to a situation where you look at the trade after the outcome, it gives you context. It gives you some perspective, right? So I'll tell you, like, for example, there's times where I know people would buy a stock or an option price at 10. They'll put a stop at 9. It would go to 9 and it would reverse. Now, if this happens over and over again, what does it mean? It means your stops are not good. Your stops are too tight. Your stops are terrible, terrible areas. Now, see, the thing is, we've identified something you're messing up on. And in trading, you have to understand that is progress, right? A lot of people identify progress with the dollar sign. Well, I didn't make money, so I didn't make progress. No, well, you just identified a problem. Now you know what to work on. Now, if you're making money and you can't identify problems, you can't identify strengths, you can't identify any of that, in my perspective, that's the real problem, right? So when you do these things, when you start really narrowing down into your data, you start really journaling, you start looking at the trade after the outcome, you will have a good idea of what happened, what was going on. And then obviously identify your R multiple. What was your R multiple? See the mistakes you made, see the setups, see the outcomes of each trade, just to get a good grasp of the data points. Write it down if you need to. Go on the trade. And at the bottom here, if you guys do have TradeZella, write down any comments you have. Write down things that you want to see. You can see your running P&L if you want to see how the trade was looking at a certain point. You want to add your chart. You want to add images. You want to add something. Go ahead. Just get clean perspective of what is actually going on with certain data, right? What is happening with a trade? What is happening with some of the positions you are taking on, right? And like I said, that will ultimately give you as a trader tons in terms of perspective on things that, you need to improve, things that you need to get a good understanding of, and things that need to consistently update, right? And that's how you'll be able to, once again, identify that weakness, right? So just to recap of what we've covered so far, we have about a couple of more minutes. R multiple, understanding what R multiple is. Everyone moving forward, identify your trades in R multiple, identify your trades in terms of risk. Then in terms of keeping your risk consistent, we want to try to keep our risk consistent, especially if you're trader ABC, meaning you're unprofitable, you're not successful, you've been going at this for some time, you're having a real hard time, want to keep your risk consistent. Then after we identify and make our risk consistent, every trade we take, want to have a setup, want to have an understanding of the trade, want to keep the risk consistent. We want to look at the trade after the outcome. We want to identify the R multiple, and then we're going to start digging into our data and identify the weakness, identify the strength, identify what needs to be worked on and where I need to kind of take a step back and cut out, right? Now going into last two things. Bankroll management and just risk management strategies, which kind of aligns right here. Bankroll management kind of kicks in for traders that are a little bit more advanced, right? Traders that have consistency, traders that have setups, traders that have one or two bad days but don't know how to manage the risk, manage their size. This is where kind of bankroll management kicks in, right? This is where you need to learn and know when and where to increase size, decrease size, play offense, play defense, right? So something about trading, something about me right now is, and it took me time, is my risk is not consistent, right? So when I talk about keeping risk consistent, well, I don't want people to go, hey, Umar, well, your risk is not consistent. You have a trade where you risk 10,000, then you have a trade where you risk 4,000. Yeah, but they're very contingent on a few things. And those few things could be something like how I've been performing recently, how my month's been going, what setup I see, market conditions. Like right now, market conditions are not the best. So I'm not going to go in risking $10,000, $20,000 a trade and go super heavy, right? So it's identifying what the market is presenting, what the market's not presenting, identifying what the setups are doing, what the setups are not doing, identifying maybe volume in the market, some liquidity, how easy it is to get in or out, especially when you're trading with size. So you need to know, this is kind of on a more advanced level, you need to know when to increase that risk, right? And this is important because if you do want to get to the next stage of trading, and if you are stuck, for people that are on here are probably in the 6-figure range or even close to 6-figure range that want to take it up a notch, this is where that will come. Knowing when to increase size, knowing when to decrease size, knowing when to be aggressive, knowing when to not be aggressive, right? So for example, for me, sometimes I'll have 2-3 good trading days, and now I'm like, okay, I'm building momentum. Now I'm allowed, not that I will, I'm allowed to increase my risk, right? Now, the psychological barrier here that happens is most of the time, guys, right? This and this happens in all stages. This is why like managing your cash, managing, your amount that you are investing or trading with, knowing when to increase or decrease that is very important, because let's just say this is your confidence meter, right? Let's just make it blue. Let's say this is your confidence meter, and let's just say you are here, okay? Let's say I take a trade tomorrow and I'm green. My confidence meter goes up. Let's say I take another trade. My confidence meter goes up. Let's say I take another trade. My confidence meter goes up. Now, typically when your confidence meter goes up and up and up and up and up, a few things happen. Number one, which is not ideal for most people unless you're able to recognize it, people increase risk. So let's say risking 3K, I might go and say, you know what? I'm so good at trading. I've been doing so well. I'm going to go risk 6K a trade, or maybe even more, maybe 12K. And then second, I start getting blinded by positions. I start getting blinded by my mental blind spots, right? So you start having like a blind eye at that point because your confidence overtakes it. Now, the fourth trade, fifth trade, whatever trade it is, you take, you lose money, right? And I'm pretty sure this has happened to people where you're like, oh man, if I took those trades and those trades and those trades and I did well, but the fourth trade I took with more size, I lost money. It's because of this. That's why you need to be able to maintain knowing and having understanding. Okay, well, just because I did well in my past 3 trades does not mean I should increase my size. You need to increase your size in contingent to also the setup. Maybe the market conditions went terrible at this point. If they went terrible, they're not as great. I don't care if I had a 2-month win streak. Size down. Be risk off. Play defense. You need to know how to manage that even when you're doing good. Like I've had days, I think it was last year, for people that have been following and whatnot, around the firm, I think last August, September, I had 2 back-to-back $1 million months. And then I think the first week of October, or the first 4 or 5 days, I took a week off. And the reason I took a week off is because I was super aware of this. And I was like, wow, like I just don't want to take on 2-3 bad positions feeling like this unless I can bring this down, because I've been in situations where I will have 100K or 200K losing week just by being or allowing my confidence to be super high, right? So yeah, that's ultimately what I wanted to cover. I wanted to just cover a lot on risk management, identifying what to do next with a strategy. This is the way I would identify risk. This is the way I would identify, quote unquote, a strategy, if you want to call it. Go off your size. You also need to understand what level you are at a trader. If you're starting out, right, you need to be very, very careful. You need to be careful at all stages, but starting out, like let's just say on the early stages, you need to be extremely careful. Here, you can start putting on more risk, but you need to have a strong foundation. It starts with the strong foundation as a trader too, knowing when to be aggressive, when not to be aggressive, identifying setups, identifying market behavior, identifying your own behavior, things like that. But the only thing, like all of those things are very important, but the main thing as a trader we want to try to do, once again, is we want to try to be alive as long as we possibly can, so we can have the most amount of opportunities, so we can get better, improve, identify weaknesses, identify strengths. And the main thing that we need to understand is our main job every single day is to manage risk. That is all, not to make money. Yes, we want to make money, but manage risk, manage risk, manage risk. And if you guys do that, if you guys aim to manage risk, track your trades, look at everything, identify your strengths, identify your weaknesses, journal every day, right? You guys will, in my opinion, do extremely, extremely well. It may not be in a month, it may not be in a day, it may not be even in 2 months, but over a course of 6 months to maybe a year, I promise you, you will have strong levels of improvement in yourself, in trading, identifying plays, identifying setups, knowing when to be aggressive, things like that, which will boost up the probability of you being successful. With that being said, I'm going to end this. And for people that joined later, this will be recorded and uploaded. Thank you, everyone, for joining.